Have you ever wondered how the very best institutions such as investment banks set themselves up for trading from a fundamental perspective? This is the only video in the public space that will go into the real details that matter, and the best thing is you can start using this information immediately in your own trading. So let me leave you with one thought before we begin. If you are not using the same information as institutions are, and yet they are the ones making all the money, you seriously have to question your current approach. Anyway, the positive thing is you're here now, and that's all that matters, so let's get on with it. Now, in my last fundamentals update, I suggested that the market was unlikely to make lower lows, and exactly as I said, the market failed to make lower lows and rallied strongly throughout January. However, February has been a little bit of a reality check for investors, and a risk-off mood has crept back into markets. January saw us up 9%, but the February correction now leaves us up about 4.5% year to date. So February saw a near 5% correction from recent highs. So as you can see, when I say risk off, I mean we have seen some bearishness creep back into markets in the last month. But do you know why? Well, if you don't, you should, because those factors will influence the market this month in March. Now, if you don't know the factors driving the recent weakness, fortunately for you, we are going to cover the reasons in depth today, so you can not only learn from it, but apply it this month in your own trading. Now, as I explained in detail in my last video, we were always likely to rally in January based on the market's expectations that the Fed may be about to pause its rate hiking cycle in the middle of this year. That was based on the expectation that inflation would soften fairly rapidly, and given the direction inflation has been going in recently, that view was probably justified to an extent. However, as I said previously, February has been a bit of a reality check for investors, as inflation readings have been very sticky recently and not dropped as much as expected, resulting in higher interest rate expectations, rising bond yields, and therefore lower equities. Now, this matters no matter which market you trade. As can be seen here, throughout 2023, crypto, FX, commodities, equities have all exhibited strong correlation, so I really cannot stress the importance of doing the hard work we are doing here, regardless of which market you trade. So getting back to February, and then eventually what we can expect in March. In February, Fed interest rate expectations moved substantially higher as a result of the sticky inflation readings we just spoke about. For example, the market implied peak in the Fed funds rate, i.e. the US interest rate, is now around 5.5% by September, compared to an expected peak of 4.9% just 1 month ago. So as you can see, the market now expects an additional 3 rate hikes of 25 basis points each this year from the Fed. This has resulted in a sell-off in markets in the last few weeks. Now, let me make this really simple for you. Markets have taken a bit of a hit recently, but for us to continue the recovery we saw in January, we need 3 things to happen. 1, inflation needs to continue to move lower. 2, the Fed needs to move to the sidelines, i.e. stop hiking rates, or at least give a strong signal as to when they will stop hiking rates. And 3, somewhat paradoxically, we need employment gains and therefore wage growth to show a slowdown. The problem we have on all 3 fronts is that none of these things are currently happening, at least not in the last few weeks, resulting in market weakness as already mentioned, and a somewhat uncertain path going forward into this month. Now let's look at inflation first. So whilst headline inflation has been moving lower since mid-2022, moving from a peak of 9.1% in mid-2022 to 6.4% in January 2023, a whole bunch of inflation indicators re-accelerated in February. The latest reading saw a spike in headline CPI of 0.5% month on month, and even the core reading jumped 0.4% month on month. This sent the bond market into panic mode, and the 2-year bond yield is now at decade highs. And as mentioned earlier, this has also been reflected in the Fed funds rate, with US interest rate expectations also jumping to around 5.4% or 3 further rate hikes this year, as I already mentioned. Now, whilst this all sounds a bit alarming, in my opinion, it was always unrealistic to expect inflation to decline in a straight line some bumps along the way are to be expected, and that's what we had in February. Now, going forward, if you think February data was just a bump and the decline in inflation will continue, that is clearly positive for markets. If, however, you think inflation will continue to be sticky, then you may be inclined to have a bearish view on markets. Either way, you need to have a view. Personally, my baseline scenario is for inflation to continue to decline simply because interest rates are elevated, and as the Fed continues to hike and keep interest rates high, we should see this have a strong downwards impact on prices throughout this year, i.e. bring inflation down. Now, I don't want to overdo it with an inflation analysis. However, this metric is so crucial to markets, it is worth just mentioning that the major driver of the inflation readings in February being so elevated was services inflation. Worryingly, services inflation is actually still rising, 7.6% year on year and sitting at its highest level since 1982. This is clearly bothering the Fed and something they are watching closely. So if they are watching it closely, you should also be watching it closely. So I think the key takeaway is that whilst inflation should continue to come off in 2023, given how elevated the services component of inflation is, we should expect a bumpy road. And whilst the Fed is unlikely, in my opinion, to raise rates significantly further past 5.25 to 5.5%, what they are likely to do is keep them at these elevated levels for quite some time until they see services inflation and also wage growth start to show material declines. So expect volatility and data dependence ahead. Finally, the labor or jobs market is a real problem for the Fed at present. Whilst you may think an economy that adds jobs is healthy, and you'd be right to think that, the problem is the side effect of an economy adding too many jobs is workers demand higher wages. And as it stands, companies are giving them higher wages, leading to price inflation. Now, a lot of this phenomenon stems from the structural issues created during the pandemic, such as pent-up demands for services, as well as workers leaving the labor force. But whatever the reasons, the result has been spiraling wage inflation. So we need to see average hourly earnings growth continue to move much lower to help overall inflation come down. The bottom line is, look for a soft jobs or payroll number to be a positive thing for markets this month. And funnily enough, a very strong jobs number to be negative. So let's conclude. I cannot stress the importance of having a baseline scenario. It does not matter one jot if you're wrong, as you can always adjust, but you need a base to begin from. Otherwise, you're just gambling. Now, the very best traders in the world have a scenario in mind. So here is my baseline scenario for the next few weeks and months as it stands. Now, I think one of the biggest stories of 2023 has been the divergence in views between what the market thinks will happen to interest rates and what the Fed is telling us will happen to interest rates. The last time I did one of these fundamental updates, the market was expecting a peak of around 4.75% in rates and then rate cuts later this year, whilst the Fed was clearly telling us there that their terminal rate was higher at 5.25%, and we would not have any rate cuts this year. In February, we saw inflation, in particular services inflation, be a lot more sticky, and the market seemed to be falling more in line with this new reality, thus closing the gap or divergence with the Fed's position, hence the sell-off we saw in markets in February. So as I said, the market now expects 3 more rate hikes to around 5.5%, which is more in line with the Fed's own prediction of its own terminal rate. The fact that the market and the Fed are now more closely aligned is a good thing, and the expectation is now for the Fed to pause in mid-2023 at around 5.25 to 5.5%. Personally, this seems sensible to me. Why? Well, historically, the Fed tends not to pause hiking until it is at or above the rate of inflation. And with interest rates approaching 5 to 5.5% and core inflation around 5.6%, as you can see in this chart, the next 2 to 3 25 basis points hikes should get us close to the end. The problem, however, is I don't see the Fed cutting rates this year, which was the previous market expectation, and that could dampen how much we see markets rally this year. So whereas before the market was pricing in rate cuts this year, those seem to be much more data dependent now, so we will simply have to see how inflation and the jobs market fare over the coming 4 to 8 weeks. Chairman Powell himself said at the last FOMC meeting that by the time of the next meeting on 22nd of March, they will have had 2 more inflation and jobs reports to digest. They can then make further decisions. So I think the market will also be a little bit sideways until we get more clarity from the next jobs and inflation numbers. So keep a very close eye on those. Having said all that, for now, a mild recession as opposed to anything more severe still seems much more probable. As I said in my last fundamentals update, as a healthy labor market should help soften any negative impact on the economy from higher rates. We saw a similar scenario in 2000 to 2001 when the Fed hiked 6 times between mid-99 and mid-2000. An inverted yield curve resulted just as we've had this time, but we only experienced a modest or brief and shallow slowdown in the economy, as the economy and the jobs market were quite strong coming into that period. That is the exact same scenario we have at present, with the economy and jobs market similarly strong coming into this rate hiking period. In fact, if we look at market performance today versus the tech bubble in 99 to 01, we can see further similarities in performance. So if this year turns out similar to that period, we should see a much milder recession. The same baseline scenario I gave in my last fundamentals update. I do expect the Fed to be successful in bringing inflation down and therefore a positive market in the medium term, but in the short term, progress is likely to be much more uncertain given the sticky inflation readings we've just had, and therefore in the short term, we will experience a road based on data uncertainty, which should keep us somewhat sideways for the next few weeks until we get to the next 1 or 2 FOMC meetings, when we'll have had 2 or more jobs reports and 2 or more inflation reports, and the market will be in a much better position to make its move. Any upside is likely to be limited for the time being at least, but on a positive note, any downside should also be limited given the soft landing scenario still being intact. I hope that was useful and something you'll agree is completely unique, but also an incredibly professional perspective on markets. Now, whilst these fundamentals are crucial, it's also equally important to be able to trade that view. And to do that, you absolutely must use order flow, something you can find out more about by watching this video here, which shows some live trading of the market using institutional techniques. See you next time.